Prescient's Africa Equity Fund invests in listed equity markets across the continent except South Africa. The fund was launched in March last year and has returned 9% per annum in local currency. The return in US dollars is a negative 5.9%. For more, the fund manager, Jonathan Kruger, joins us from Cape Town. Now, Jonathan, generally quantitative investing is not associated with stocks on the African continent, and yet this is a formula that you are deploying and you are deploying successfully. Can you tell me why you've decided to go this route when choosing stocks on the continent?
Yes, Bronwyn, we do employ a quantitative model, and we think that employing approach where you don't forecast and you don't get caught up in the emotions of the markets will yield the best results. So when things aren't looking particularly good in a country or valuations have changed significantly, you will be on the right side of the market in terms of buying low and selling high. So the whole idea is to not let your emotions take control of you, but rather act in an objective manner. Select stocks based on valuations.
Hi, Jonathan. Viv here. Everyone knows, of course.
Hi, Viv.
Hi, how are you doing? Everyone knows the Africa story with regards to basically growth being strong, etc. But we've seen other parts of the world, for instance, China, where growth remains in the 8-9% level, but the stock market itself doesn't perform. Have you found that a strong correlation between economic growth in Africa and performance in the stock market?
Viv, I think it totally depends on the cycle in the markets, and what we've seen is we get risk off and risk on scenarios. So if I can take you to this year where we have seen renewed interest in the continent, the economics are looking good. We've seen a return of the Nigerian banking sector following a rather difficult 2008. So in this year we've seen returns coming through in line with the growth in the economies. However, there are risk-off environments where we see that despite what's happening in the underlying economies, the markets may fall if global investors are pulling out of the local African markets.
You obviously are going after the most liquid environments on the continent, and you mentioned, of course, the hubs in both West Africa and East Africa, namely Nigeria and Kenya. Then also Mauritius is on your radar screen. We've got Tunisia, Egypt and Morocco. Are those your key territories, or are you more widely spread?
Bronwyn, yes, we do focus on those markets, and we've looked at all the markets across the continent, and we've decided to invest in the ones that are more liquid. And we find that there can be liquidity squeezes where markets are virtually untradeable. So we'd like to stick to the more liquid markets, Morocco, Egypt being the emerging markets in Africa, and then Kenya and Nigeria, fairly liquid markets, and smaller markets such as Mauritius and Tunisia.
Hi, Jonathan. Viv here again. I notice of your top 10, half of them are banks, and in fact your top 3 are entirely banks. You have a lot of faith, obviously, in the financial or the future for the financial sector in Africa, while the rest of the world, for instance, in the US and Europe, etc., the financial stocks have been quite badly hit. Do you think this is a trend that's going to continue for quite some time?
Viv, I think the African banking sector differs in certain ways from the global banking sector in that the way their businesses operate. And if we look at the credit crunch, the African banks weren't involved in all of the risky products that developed markets were involved in. And we've seen different dynamics on the continent where the local banks are tapping into the consumer sector, largely through retail deposits, and on the lending side, lending to corporates. So I think the risks are different. It depends on the regulation. And what we've seen in Nigeria and Kenya is that a shake-up in the banking sector, especially in Nigeria, has resulted in NPLs coming down, better asset quality on the bank's books. And we've seen the regulators step in there quite strongly. Sanusi, the governor of the Reserve Bank, has done tremendous work in terms of cleaning up the sector. And we've seen a lot of the bad debts transferred to the state asset manager, AMCON.
Viv again. Basically, I see that you're playing the growth in Africa. Obviously, people say when the economy grows, banks will do well, and therefore obviously you'll have that leveraging off. But nothing that does well when the economy grows is retailers. And I noticed that's a bit lacking in your top picks here. Whereas in South Africa, a lot of our retailers have been pushed quite strongly forward because people believe in the Africa story. Do you think the African retailers are going to be basically unable to compete with some of the international inflows that are coming in?
And perhaps adding to that, Jonathan, does that mean that you are accessing the Africa consumer story through financials rather than attempting any retail play?
Bronwyn, and Viv, that's a very interesting point. And we do look across the markets. Unfortunately, the African markets are concentrated mostly in financials. So that's where a lot of the opportunities lie. Yes, there are opportunities on the consumer side, but if we look at the markets, we see that a lot of the consumer stocks are very expensively priced. So if we look at the brewers, if we look at East African breweries in Kenya and Nigerian breweries in Nigeria, we see that these companies are operating at P multiples 20, 25, even 30 at times. So we see them as fairly expensive, and we've recently seen Nigerian breweries has come through with relatively flat earnings. Whereas if we look at the banking sector, it is a play on the consumer as well, and we have seen profitability returning to the sector. So yes, we like the banks as an avenue to go into Africa at this stage. However, it is entirely dependent on valuation. So if we had a case where the consumer sector, the brewers, became a lot cheaper, then yes, we would be more heavily in those sectors. Having said that, we do have other components in our quantitative model that do pick up more expensive stocks that are continuously running. And if you look at our top 10 stocks, we do have Nigerian breweries, and that's largely a momentum play with the growing earnings and future prospects.
Hi, Jonathan, Viv again. Really, quant models, obviously, one of the things that you depend on is the assumptions, and the assumptions do change over time. And obviously, in the last year or so, the biggest assumption change you've had in Africa is the Arab Spring. So you have quite a large holding in Egypt, and also, obviously, you also have holdings in Morocco and Tunisia as well. And Egypt currently is a bit under, a bit of a cloud of uncertainty due to the Muslim Brotherhood and the conflict with the military and so on. What adjustments have you made to your quant models to try and reflect the changing uncertainty that we've seen over the last year?
Viv, we do look very closely at the political situation and the economic situation of the underlying countries. However, the model is a bottom-up model, so we're looking for value on an individual stock basis. Given what's happened in Egypt, we started the fund after the Arab Spring. The market was closed, the market fell dramatically, and we thought that the valuations in the Egyptian market warranted taking on the risk. And what we saw is we had to wait a fairly lengthy period of time to the beginning of this year, where we saw the market, some stability returning on the political side with a peaceful parliamentary election, the election of Mohamed Morsi, and we saw the market rallying significantly at the beginning of the year. We were overweight then, and we actually cut back on our position a bit. And more recently, we have increased our position again with the market coming down. And yes, there are concerns over the Egyptian pound, and we monitor that very closely. We're monitoring the potential IMF loan, which is firmly back on the cards now with the new president making this a top priority. So we see reserves fairly low, but we're constantly monitoring the situation.
Jonathan,
so to answer your question, we won't necessarily directly intervene and override our model. It only under certain circumstances where we see the risk not justifying the valuations
Jonathan,
that our model is indicating.
One of the other enormous themes on the continent is obviously the mining environment, resources, oil, gas. And as Viv pointed out, the retail story is missing from your top 10. I would say so too is the resource story. Is there obviously a rationale behind that?
Bronwyn, if we look at the opportunity set in the markets that we focus in, there actually are no, I would say, pure resource plays. It is rather unfortunate that in the continent the listed resources are not actually listed in Africa itself. So if you're looking at your Shells and your BPs, a lot of the oil funds off of Kenya and Tanzania, you can't get direct access to that via the listed market. So yes, we don't have a strong resource component to the fund. However, if we look more on the industrial side, we do have some exposure to Orascom construction in Egypt, and that's been performing fairly well. And then also in Nigeria, we do have some Dangote cement.
Viv again, with regards to your weighting, you mentioned that you were underweight or overweight in Egypt at the start of the year. Obviously, the weightings in the continent are not reflective of the economies of the continent because certain stock markets are far larger, the Egyptians and the Nigerians, as you would know. Have you taken any steps to basically try and correct the weighting of the stock markets so they more closely reflect, for instance, the weighting of the economies of the continent?
Viv, in fact, we haven't done anything in that regard, and we do look fairly closely at the benchmark, which is the MSCI, the Emerging and Frontier Markets Africa, excluding South Africa index. And yes, that is a market capitalization index, and we do base our fund around that index. And the reason for that is that it's an investable market universe. And unfortunately, even if there was huge potential in, say, Tanzania, the market simply isn't liquid enough. So it is difficult to allocate your fund according to the underlying economic potential per se. We have to look at where is the value on an individual stock basis in each market and access the growth in that way.
Well, taking into account what you've just said and saying that you access the growth through individual stocks, can I ask you which territory you think is the next investment frontier? There could be some stocks on your radar screen that you are adopting a wait and see attitude and about to deploy money into.
Bronwyn, we are invested in most of the stocks in our universe, and I think where we positioned at the moment is largely in the banking sector. We don't have any stocks that we excluding at this stage in the banking sector. So yes, we're seeing the opportunities there. Our model does focus on value, so that there are some stocks which haven't performed particularly well where we do see value, and we've seen that in a couple of the stocks. Some of the Mauritian stocks, for example, have come off a bit. We haven't seen momentum returning to the market, but we do have some positions there. So in terms of accessing those stocks where momentum hasn't necessarily returned, we are there. But in terms of how our model is structured, we do prefer the stocks that are showing value and also showing momentum to avoid getting stuck in a value trap.